Yeah, hello again, everybody. Here's now another small video on business taxation part 2, that is partnership taxation. And today I'm going to speak about uniform and separate assessment of a partnership's results. Well, where are we? We are now after the basics, which we had yesterday. Um, Concentrating on the role of a partnership for the determination of the tax base. So we talk about what is the importance of looking to a partnership in German income tax or corporation tax law. Well, now you remember that partnerships are not the taxpayer. So they have, nevertheless, in a limited way, still a certain role for what's going on, for determining the tax base of the partners. Mainly, there are two aspects. The first one is there is a so-called uniform and separate assessment of the income, which is achieved by the partners from the partnership. And there are some rules to be mentioned, which you already heard about in General Introduction to Tax Law, I believe, if I correctly remember. That is some simplification rules for the determination of the type of income where we have to deal with. These are especially and only for partnerships, and they are laid down in paragraph 15, subparagraph or section 3, numbers 1 and 2 ESTG, so of the German Income Tax Act. Well, let's begin with the beginning. So that's the first aspect which is important, the so-called uniform and separate assessment. The best thing to understand the rule is always to begin with the problem. So imagine that a partnership has three different partners and we name them today A, B, and C. Each of them has 1/3 of the profit. Now you know not the partnership is taxed, but the partners. And the determination of the profit of a partnership can be complicated. Imagine they run a shop, so they have to make a balance sheet and have to do bookkeeping, so that's highly complicated, and there might be different opinions what concerns details. For example, depreciations have to be based on an estimate how long the useful life of the one or other asset will be. It can be that there are different opinions held by the one or other tax official. So different people working on the profit of that partnership can and would probably come in certain details to different results. You might think about accepting a certain reserve as justified or not, or what else. You can discuss many details when it comes to determination of the profit of a partnership where, let's say, 100,000 transactions have been done during the year. So we can prognosticate if several different people have to compute the profit of an identical enterprise. First, everyone will probably come to a different result, and everyone will have to do the same work again, so it would be a huge amount of wasted working time. Um, and if you have contradictory results, by the way, here I have, the profit will be different. That's a second aspect. Sorry, naturally, the bullet points here belong to the second entry. So now imagine everyone computes the whole stuff again and ends up with slightly or hugely different results. What does that mean? Well, imagine A, B, and C have, as I said, the same partnership. Everyone has 1/3. Now A is informed by his tax official that his 1/3 is from the perspective of that personal tax official 100,000. B gets the information, well, I assess you with 120, and C gets the information, your share is 150,000. Now, A, B, and C know one thing for certain. Each of us has 1/3 of the same amount, and 1/3 of the same amount must result in the same amount. So it can not be that 1/3 is 100,000 for you, 120,000 for me, and 150,000 for you. So that violates the rules of logic, and so that will create a lot of trouble and legal discussions, and A, B, and C will probably lose all their faith in justice and fairness. And apart from that, 3 times the same work to be done by 3 different people. So that can evidently not convince, and for this reason, German law says if we have a partnership, then the assessment of the income achieved by this partnership is done once and for all, only once. So this determination or decision how much the partnership has earned is done in a uniform way, which counts for all of them. So the profit is only once determined by the administration, and then in combination or resulting from that assessment, every partner gets then the information. We found out you have your share is, let's say, 100,000. So then it's impossible that the outcome can be contradictory, because if you once assessed or decided that the partnership had a profit of 300,000, then it's clear that 1/3 is 100,000 for each of the partners. There will be no conflict. Or if you say the partnership profit was 450,000, then it's logical that everyone has to pay on 150,000. 1/3 is again the same for all of them, so you can avoid contradictory outcomes. So you have either 100,000 or 150,000, but you don't have 100,000 for partner A, 150,000 for partner C, although it should, under logical aspects, be the same. So that's a great achievement by a uniform assessment, and that seems to be necessary, naturally. Furthermore, you save a waste of working time. One tax official gets the job. Please find out the profit of that partnership, check it, establish that this corresponds to the legal rules, and what you decide counts. So, and then we can inform everybody what his or her individual share is about. Then, naturally, if that partnership is assessed in a uniform way, you can no longer give that task to one of the individual tax officials. Let's say you have partners A, B, and C, then you can't say the first tax official working on one of the partners then has to take the work or the workload and to do the uniform assessment. That would end up in chaos. So you can only separate this assessment procedure for the partnership from all the rest. So in practice, you need the tax assessment for the individual partners. No, you need the partnership assessment and the results for the partners before you can make the final income tax assessment for each of the partners. So you separate that procedure from the tax declaration of the partners. The partnership hands in a tax declaration. The partnership profit will be checked and determined by tax assessment. That's the uniform and separate assessment, because it is done separately from the overall income tax assessment of each individual partner, because you know now you need that result separately already in advance. Sometimes in practice that does not really work perfectly. Let's say if the uniform and separate assessment is delayed for the one reason or other, then your individual income tax assessment might be provisorily made up based on an estimate and later it will then be corrected when the uniform and separate assessment comes in and the administration has finally determined how high your profit share really has been. Then the original estimated or provisory assessment for the taxpayer will be corrected. But logically, you need the result from the separate assessment before you can finally set up the income tax for the partner. So now, how would it work? Partner A has income from a sole proprietorship of 100,000, but also profit share of 1/3 in ABC partnership. Now, in order to know A's worldwide income, you need to know first all the income A made alone. Here's a sole proprietorship income, but also you need the amount which results from the partnership. So until you have the final assessment, you have to wait for the uniform and separate assessment. So the uniform and separate assessment must be done, and the result must be communicated to the tax officers of each individual partner which is involved in the partnership. So naturally, the separate assessment will be done in a way that the tax officer responsible for that communicates the results to each tax office and to each individual partner which is subject to that or involved in the partnership. Okay. Now that uniform and separate assessment would end up again in a complete chaos if by objection to the tax notice, each individual partner could attack the result of the assessment by filing objections against the final income tax notice again, and then have the amount changed. Imagine the following. Imagine that the uniform and separate assessment of the ABC partnership leads to a profit of 450,000 for the partnership, and so each individual partner gets the notice your profit share is 1/3, that is 150,000. Now the tax officials begin to write to compute the worldwide income of these people, and now imagine now A detects I'm not satisfied with the 450,000 and my 150,000 share. So I dig up some reasons and file an objection and say to my fiscal officer, the profit of the partnership was only 300,000 and my share is therefore only 100,000. What happens with B? B, living somewhere else, also files an objection, brings forward some reasons, says, the partnership profit can't have been 450,000, but his tax officer is not so credulous as the one working on A's case. So imagine now that tax officer says, okay, I believe it was only 120,000, and C does not even dare to contact the fiscal office. C believes in everything. And so in the end, we would have again that complicated, absolutely contradictory and senseless status that A is taxed on 100,000, B on 120,000, and C is taxed on the basis of 150,000. Although by all principles of logic, it should have been and must have been the same amount. So that can't be. So the original chaos would come back if we allow objections on the basis of the individual assessments for the partners A, B, and C. So what can we do? Everybody should have a way to object, but naturally that should only be against the uniform and separate assessment. So the whole procedure is separated from the rest. The general tax code in Germany, the Abgabenordnung, simply says, well, the procedure for the uniform and separate assessment is a separate administrative decision or administrative act. And as you already heard about that in General Introduction to Tax Law lecture, an administrative act, something which an authority, a state authority decides, is binding and remains valid if you do not object against it in time. So even if it's wrong, if you are ordered something, it is always assumed what an authority orders is in compliance with the law. If you do not bring forward an objection within a reasonable and strictly determined period of time, usually 1 month, then the whole thing is definitive and the decision is binding for you until it's officially changed. And very often that's not easy. Especially with the tax notice, you can only have it changed under very restricted circumstances. You already heard that too. So the Uniform and Separate Assessment is administrative act. It's binding if you do not object in time. And if you object, then the whole thing is renegotiated and checked, and then in the end you get a definitive Uniform and Separate Assessment, which then says, okay, profit is not 450, profit is, let's say, 420,000. Then again, 1/3 of 420,000 would be 140,000 for each of the partners. But then this is the final non-contradictory and binding solution. So once that procedure is over, the result stands and is binding. Again, a tax notice can only be changed under very restrictive circumstances. The same applies for the Uniform and Separate Assessment. If you want to have it changed later and you have a good reason, or if the authority wants to change it and has a good reason, for example, they detected tax fraud or so, then it is again changed, and then again the changed assessment will be binding for the individual tax computation, tax assessment of each individual partner. But the decisive thing is the partnership profit can only be taken over from the result of the Uniform and Separate Assessment. So what is written there is binding for your individual tax official, because otherwise the whole thing would end up in a complete mess and a chaos. So that's binding. Now, if you get a Uniform and Separate Assessment and you forget to object against this, later you can no longer bring forward any, or at least not easily, any argument that you want to have it changed, because once and for all, if the Uniform Assessment and its result has become binding, then it's binding. You can't reopen the procedure without a very, very good cause. By the way, when you deal with a partnership case, usually one can only ask you how high is the income of the partnership, which type of income will it be, and so on. It's usually not possible to ask you for the resulting income tax for each individual partner, because for each individual partner they will be assessed on their worldwide income from all their sources of income. And so naturally the individual partner, let's say partner A, will probably also have income from other sources apart from that partnership share. So A might have job income from lease and rent from houses. A will also nearly certainly have special expenses, so personal allowances, which you can deduct from the overall income, or might even have extraordinary expenses, that is, allowances for extraordinary personal hardships. You had an accident and now sit in a wheelchair, so that you need more than the basic allowance for your basic needs of life, and all that. And as long as you are not given all these details on an individual partner, nobody can ever expect from you to calculate the tax for partner A. The only thing you can find out in a partnership case then is the overall profit resulting from the activities of partnership ABC are, let's say, 450,000, and partner A has a share of, let's say, 1/3. So partner A obtains a profit from that partnership amounting to 150,000, and it comes from, as the separate assessment says, it comes from this or that type of income. More is not possible, and can't be expected from you in a partnership case. Well, yeah, now another small topic, that the second aspect for which the partnership is basically relevant, because naturally when you get assessed, it's an important fact from which type of income you derive your income. You know, the rules for taxation of income from lease and rent or income from business are partly very different. So in combination or during the uniform and separate assessment, the fiscal authority will also decide what you are doing there in the partnership. Is it only lease and rent income, or can one qualify your activities as business income? Again, that would be highly contradictory if partner A gets an assessment which says you have to declare this as income from lease and rent, and partner B has to declare it as business income. So also that must be decided once and for all and in a uniform way. So it will be decided in the uniform and separate assessment. But now imagine a partnership had 7 different types of income, and you have then later a massive debate about which 100 euro come from which type of income. Here, in the course of the historical development, German law has established several simplification rules. Whereas an individual always can have all the 7 types of income, several simplification rules came into being concerning partnerships just to make life more simple. The first one can be found in paragraph 15.3 number 1. It's the so-called Abfärbetheorie, or called infection theory. That is plain and simple: if a partnership has at least one genuine business activity, then automatically all what they are doing, all income from which source ever, is reclassified into income from business. And it's called infection theory because the idea is if you have one little business activity that infects and spoils all the rest of your income, it's now all business income, by the way, with the consequence that it would all be covered by the trade tax of the cities too. And the second simplification rule is the so-called structure theory or structure rule, in German called Gepräge-Theory. Nein, Gepräge-Theorie naturally in German. Clear. You can put it plain and simple: if a partnership has a limited partners, so if it's usually a KG or another form of a limited partnership, then if the only persons who are allowed to run the business as managers are the juridical persons, so the GmbH, for example, or employed persons, then automatically everything what this partnership does is classified as income from business, even if it has no genuine business activity at all. To put it plain and simply, what does it mean if you have a KG where the limited partners have no influence on the management? Well, then this rule applies, and then everything is reclassified into income from business. For reasons for that later. Let's begin with the first thing. But the most important conclusion is for dealing with cases in exams or during preparation. Because if you have an OHG or another partnership with several activities and only one is mentioned, let's say the second one is OHG runs a shop, then you can directly stop thinking about the types of income. Everything this OHG does is income from business. So you can directly write down ABC. OHG is not a taxpayer, but the taxpayers are the partners here, ABC. A is unlimited tax liable, B is unlimited tax liable, C is unlimited tax liable because of blah blah. And then you can say the OHG is only relevant for the determination of the income resulting from the partnership that is done by uniform and separate assessment. And then you can write the decisive sentence. And as ABC has at least one business activity, here the shop mentioned in number 2, all income of ABC is automatically income for business, see 15.3 number 1 ESDG. So you have already then sufficiently covered one of the basic questions: which type of income is it, where the income comes from. And then you know the rules and what you have to look for. That infection rule or theory has some interesting consequences. The first one is, if a partnership only has business income, then all property of that partnership is automatically business property. So if an OHG sells a house after 20 years, which has been let to tenants, that will not be tax-free, because only private property can be sold tax-free after 10 years under German law. Business property is, when sold, always taxable. Then, second important consequence. If a partnership owns, let's say, 100 houses with tenants inside, then all its income would be lease and rent, and accordingly all the houses are private property. Now that partnership decides to open a small shop, sells newspapers or so. Additionally, then all the activities become business activities now under the rule of 15.3 number 1. So all the houses begin to become business property. So they turn from private property into business property, so that would be regarded as a contribution of all the houses into a business property at this moment. And even worse, the opposite of that. Imagine you have now such a partnership with 100,000 and a single small shop selling newspapers. You decide to close down that shop. So afterwards, this partnership no longer fulfills 15.3 number 1. So it has no longer business income. So the income from the houses is again lease and rent income, and the property is therefore again private property. And that would imply that by closing down the shop, you also turned a mass of business property, all the 100 houses, into private property. And turning business property into private property is defined as a withdrawal. And the withdrawal has to be taxed as if you had sold for the market price at that moment. So you would have to pay enormous taxes on all the increases in value since the moment when you contributed these houses or bought them, although you have no cash. So this, let's say, negative effect of 15.3 number 1, when it no longer applies, is highly dangerous. And so everybody should keep that in mind. Therefore, it's important to know the tips, how you can avoid, if you want to, the consequences of 15.3 number 1. The first recommendation is, do not form a partnership, act as an individual. Do not work together with others with a common aim. Very often, for example, in free professions, you see things like 3 people of the same family sharing a doctor's practice. And now you don't see a practice label which says Dr. Gerald Smith, Dr. Elfriede Smith, and Dr. John Smith Jr. together, but you see 3 different labels on the door. One, Dr. Gerald Smith, below Dr. Elfriede Miller Smith, and then separated from the 2 again, Dr. John Smith Jr. Why? This way they show to the outside world, well, although we work in the same rooms and share the rooms for our work, We do not form a partnership. Everybody here in these rooms fights for himself. All our revenue is not shared. Everybody fights for himself. We just share the rooms. So we don't have a partnership contract, not even an oral one. That is what they want to show to the outside world and especially to the tax inspection. The other alternative is do form two partnerships, two different ones. One partnership where you only do the business activities, and the second partnership separated from the first one, which follows the aim to do the non-business activities. So our ABC OHG might have been wiser to say, we run a shop together in form of an OHG. And then ABC do form a second partnership contract. Now the aim is, let's buy some houses and invest some capital together in form of a simple partnership, a GBR. And surprise, it works. A partnership, or you can form several partnerships with the identical persons, because a partnership is strongly defined by its aim. So if you unite to do a holiday trip together, this is a partnership. But if you also agree to open a business next year, this is a completely different aim, a different partnership contract is possible. And so one of the recommendations in practice and for practice is, if you decide to work with several people, form different partnership contracts. But then naturally there is still the client risk. You must avoid then that A, B, C, or one of these partners begins to do a business activity in the non-business partnership, because then you spoil the whole construction. But if it works, so if the people stick to the rules and say one partnership is for the business activities, one is for the pre-profession activities, or for the lease and rent activities, then it completely works. So the negative effect can be easily avoided if people are clever enough. By the way, there is even a nice effect of that second rule, the so-called Geprägetheorie or structure rule, 15.3 number 2. By the way, if you wonder about that, my personal explanation, or what I suppose, is that, if a GmbH exists, all what it does is classified as income from business. Now, if a GmbH or a similar juridical person then is a full partner of a KG and takes up limited partners and restricts their role to just giving capital, then this is nothing else than a kind of loophole to escape the 8.2 consequences that everything a GmbH does is business activity. So I personally assume that jurisdiction will have quickly draw the conclusion that such a KG structure where a GmbH is the only full partner is nothing else than a kind of a loophole to escape the A2 KSTG rule, and then that they draw the consequences. This can't be. We are going to treat this as a tax abuse, and later, naturally, people will have said, okay, to make things clear and to fix this, and as tax abuse is always debatable, we just lay down this principle exactly in the text of the law and say, such a structure of a GmbH and co-KG or a similar structure entails classification of everything as business income if that what the limited partners can do is nothing which has to do with management functions. So this is nice to understand, and it can also give us a tip for tax saving, because sometimes it can really be helpful to set up such a construction. Imagine again, we have our 100 houses in the OHG and the one simple small shop. Now we want to close it down. That would bring along the withdrawal of all the houses, because now we would have lease and rent income. Now a good tax advisor would say, no, before you close down the shop, you are going to restructure the partnership into a GmbH and co-KG. And you take great care now that none of the limited partners, but only the GmbH or an employed person does the management, because then 15.3 number 2 takes effect. And so your 100 houses would remain business property and your income would remain business income even after you close down the shop. So you can avoid the withdrawal of all the property, can live happily ever after, and you will only have to sell to pay taxes on the gain from the houses when you really sell them far away in the future, and that would be naturally great. Okay, that shall be sufficient for this part of partnership taxation, and I hope you come back and listen to what is going still to come on the rest of partnership taxation. Thanks for watching. I look forward to seeing you again, and have a great day. Ciao.